Hello and welcome everyone to another StashAway market commentary. With us, of course, our Chief Investment Officer, Freddy Lim. Freddy, how are you?
Hi there, Philip. How do you do?
I'm doing really well. I'm doing really well. Hey, for everyone, I know it's been an extra week to wait for our market commentary, but we have so many good questions. I think Freddy's excited for that as well. Same with me. Before we get into those, let me give you a really quick sneak peek. This week, we're releasing our latest In Your Best Interest podcast episode. And if you're a fan of the Financial Samurai blog like I am, you'll be pleased to know the Financial Samurai, Sam Dogan, is a guest on the next episode of In Your Best Interest coming out this week. He shares how he achieved financial freedom at age 34 and how you can get started with his pre-retirement checklist as well. So it's available on stashaway.com/podcast or just search for In Your Best Interest on any of your favorite podcast platforms. Freddy, biggest news over the last 2 weeks obviously were the inflation numbers coming out of the US, right? I think they came in at about 4.2%, which obviously is higher than what people usually want, which is around the 2.5% mark, right? What impacts does that have? Maybe you can put that into perspective for people because we got quite a lot of questions about the inflation headlines, right? So we want to address them from the top down from you first.
First of all, it was shocking economists because they didn't expect it to be going from 2.6 to 4.2 for the US. Rest of the world, like China, also seen some rise in inflation, but it's like 0.9, right? So it's very small. It's a very unique to US. And this 1.6 percentage point of increase, 0.7 percentage point came from the base effect. So meaning, if you compare this month versus the same month last year in the COVID low, the lows I'm referring to the real economy, when you have this huge lockdown and drop in prices, discounts, and so on, that contributed 0.7 out of 1.2. So really the increase is 0.5. And that 0.5, as you know, can be due to, it's actually more related to supply chain disruption during the pandemic. We've seen metal prices, especially copper, which is used in a lot of industrial uses. Is also quite green, and you've seen a lot of price increases in copper, energies. You also seen food prices going up last year. These are all supply chain related problems, and they are short-term in nature.
Same with I was just talking, Freddie, to some of my friends here in the US, right? And the prices of lumber have gone up through the roof. So actually housing prices therefore have been going up because building a house now, I think that even on Bloomberg, there was the other day a chart, right? For $50,000 worth of lumber, you were used to be able to build 10 and a half houses. And since this was last year, and now you can only build 2.5 from that lumber, right?
That's a great example. Yes. And so my whole point is, if you want to look at it forward, depending on how we are able to reopen borders, this is going to stay a couple of years until industries readjust the supply chain, right? China already started adjusting. They try to cram down on the rampant buying in copper, right? Because it's costing them a bomb now, right? Or we just reopen because we have the vaccine drive, right? Or if we have setbacks, then this thing stays in place. So it's really a COVID thing. It's got nothing to do with central bank policy. It's got nothing to do with central banks should hike rates now to stop inflation. And I think that's foolish because you're making things worse, making things harder for the average person. This inflation is not coming from financial alchemy or engineering, right? This is a supply chain problem. And so long term, we mean 5, 10, 20 years. This is not considered long term. It will take a couple of years if we stay in this mode. But it is raising eyebrows for investors.
Yeah, no, absolutely is. And let's get to the questions then, because I think some of them actually build up on that topic, right, Freddie? So first question is regarding our gold allocation. So Flame of FI is saying, always looking forward to your market commentaries on Fridays. Thank you for listening. He says he understands now the rationale of having gold within the portfolio by listening to the previous talks that we had, Freddie. He just wants to understand, the basis of why it's taking up 15 to 20% in some of the portfolios rather than a small allocation. And to add to that, David Chang, right? He said, from his understanding, adding 20% gold to portfolios raised a lot of eyebrows among the investment community. So both questions talking a little bit about the size of our allocation towards gold, right?
We first raised a lot of eyebrows already back in December 2017 when we first reoptimized this portfolio for everybody on the platform, and we bought gold. We bought up to an IBOR load of 15% since December 2017. And that was a valuation driven reason. And by the way, it's not me doing 15. This is a machine driven decision, data driven, systematic decision. I'm interpreting the signals to you. And back then it was because gold was severely undervalued versus economic fundamentals and interest rate, and at the second most distressed level ever. We bought it at 1242. And today, I think if you look back at last couple of years, we've been even to 2000. We didn't care, and we still have it. And now we think we're 1849 or something. Yeah, we make long-term decisions, but data-driven decisions.
Yeah, no, absolutely. Thank you, Freddie. David Cheng was just adding a second question to it. Maybe you can just clear that up really quickly. He's inquiring, what are our thoughts between GLD versus physical gold, since physical is fully backed and he thinks GLD is not. Can you maybe explain that really quickly?
Well, having physical gold in your hands is one thing, but if you buy a lot, it's kind of impossible. And the retail pricing and the way it's delivered, there's a huge spread in the physical retail markets. I think commissions can be as high as 10%, right? So it depends on where you are. With GLD, is also physically backed ETFs with standardized gold bars of a certain quality and weights stored in the vault of HSBC London. And so you are getting quality storage, custody services, and exposure to the metals in any amount you want flexibly with a small spread. So why not?
Yeah, and David, thanks for the question first of all. So if you want to learn more about gold, we actually, on our other podcast, In Your Best Interest, Freddie and myself were actually joined by one of the heads of the GLD fund from State Street, actually talking all about gold and the GLD ETF. So if you want to listen to this, I think we'll put the link in the show notes below so that you can have access to that. But if you Google that in any of those apps, you can find that episode as well. So you can learn more about GLD and gold in general. Next question is from WF Yeo. He's saying, is StashAway considering iShares Hang Seng Tech ETF as a replacement for KWEB? Freddie?
It's always been there as a backup ETFs or replacement ETFs. It has been there. Last year, when we first invested in KWEB, the Hang Seng equivalent was very new. And it has since performance is actually catching up to the KWEB, and probably the lower expense ratio is starting to see a bit of advantage. However, having been through the COVID-19 pandemic liquidity squeeze last year, we are very focused on making sure our clients get the money back when they want it. And so the liquidity profile for the 3067 HK ETFs, the Hang Seng Tech ETFs, is currently not, when you on a comparison basis, is significantly lower than the KWEB. The KWEB has a liquidity score versus its peers of 95 percentile, while the Hang Seng equivalent is 75 percentile. Actually, by StashAway standards, we prefer 98, 99 percentile. Normally, most of the ETFs we use, they belong to 98 and above. And 95 versus 98, 99 is actually quite a bit of difference already. 75 fifth percentile versus 95th is a dramatic change. So we think it's too premature to go in there just because it's slightly better over the last 1 year, whereas KWEB has like a decade of track record, if I remember correctly. If I'm wrong, it's at least 7 years. So so the track record doesn't matter as well, the historical duration. So
yeah, no, absolutely. And last but not least, Freddie, last question is from Wilson Young. He's saying, hi, StashAway, I would like to ask what's the rationale behind selecting the AXJ ETF over the VWO ETF, Freddy?
Actually, not over. VWO has been replaced by SPEM, the State Street equivalent. But it's on the list. You may or may not see it on your portfolio because the algorithm choose not to invest in it. There's some portfolio, the very highest risk levels, you may see both SPEM and AAXJ. But just be careful. The algorithm does adjust for the double counting because both has a significant amount of China. So SPEM has about 37.5% in China, and AXJ has about nearly 40%. But that's a lot of double counting, and that's adjusted by the algorithm for sure. But some of you may not see it because you're not in the highest risk level. I think only the highest two portfolios would have one or two of them, and in small quantities at the moment.
Perfect. And last but not least, we do have a bunch of webinars coming up actually for everyone that is interested to attend any of those. For our Singapore audience, we have a Ask Me Anything called StashAway Term Live panel discussion. Ask Me Anything. That's Thursday, the 27th of May, 7 p.m. to 8 p.m. In Malaysia, we have our What's Your Financial Plan B seminar. That's on Wednesday, the 26th of May, 7 to 8 p.m. local time. Now that we're also live in Hong Kong, we have a great joint webinar coming up. It's called Between Us and Spider, so State Street. It's called StashAway, Diversifying and Growing Your Wealth with ETFs. And it's actually going to be in Cantonese. That's Tuesday, 25th of May, 7 p.m. to 8:15 p.m. local time. We hope to see as many of you as possible at all of them. And as always, please leave your questions in the comment section below or send them to us at support@stashaway.com. And Freddy and myself will be picking those up for the next time we'll be with you. Until then, have a wonderful rest of your week. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.